December 1st, 2001, Argentina's government does something no G20 adjacent economy had done in decades. It freezes every bank account in the country overnight. Not just yours, everyone's. The limit, 250 pesos a week, in cash, from your own money. People who had spent 30 years saving for retirement watched their life savings become a number on a screen they couldn't touch. Within 3 weeks, the president had resigned by helicopter. 5 other presidents would cycle through in the following 2 weeks, and the country would default on more sovereign debt than any nation in history up to that point. Most people who survived that collapse lost everything. A smaller number didn't just survive it, they came out richer than they went in. 4 specific positions protected them. And one of those 4 is something your bank would never suggest, because it means not trusting your bank at all. To understand who won, you first have to understand the trap that was built. For a decade, Argentina had run something called the Convertibility Plan, 1 peso, fixed by law, always equal to $1, passed in 1991 to kill hyperinflation that had hit Argentina in the late 1980s. It worked, for a while. Inflation collapsed from over 3,000% a year to nearly zero. Foreign capital flooded in. Argentines got used to a currency they trusted enough to hold like dollars because the government insisted it was as good as dollars. But a currency peg is a promise, and promises cost money to keep. To defend the 1-to-1 rate, Argentina couldn't print pesos freely. So when tax revenue fell short, it borrowed in dollars from international markets at climbing rates as investors grew nervous. By the late 1990s, the country was locked into a currency it couldn't devalue and a debt load it couldn't inflate away. The 2 escape hatches every government reaches for were both welded shut. By 2001, capital was already fleeing. Argentines who sensed what was coming were quietly moving deposits out of pesos and into dollars, or out of the country entirely. Economy Minister Domingo Cavallo's response on December 3rd, 2001, was the Corralito, Spanish for Little Corral, a hard limit on cash withdrawals designed to stop a bank run that was already underway. It didn't stop the run. It just locked everyone else inside the corral with the money that was leaving anyway. 19 days later, President Fernando de la Rá left the Casa Rosada by helicopter as riots filled the Plaza de Mayo. Argentina would default on roughly $100 billion of sovereign debt in January 2002 at the time, the largest sovereign default in modern history. By the time the peso was allowed to float freely a few weeks later, it had lost close to 70% of its value against the dollar. GDP contracted by more than 10% that year. Unemployment climbed past 20%. More than half the country fell below the poverty line within months. Against that backdrop, here is what actually held value and who ended up ahead. Everyone will tell you the answer to a currency collapse is hold dollars. That's accurate. But the version of that advice that actually worked in Argentina had a condition attached that almost nobody explains. The dollars had to be outside the banking system entirely. Here's what most retrospectives leave out. Argentina had a large dollar holding population. Before 2001, a decade of convertibility had normalized dollar bank accounts, and plenty of Argentines believed a dollar account was as safe as a dollar bill. On December 3rd, that belief was tested and failed. The Corralito didn't just freeze pesos, it froze dollar-denominated accounts too, and when the government needed to make its remaining dollar reserve stretch, it did something that broke the entire premise those depositors had trusted. In January 2002, it forcibly converted dollar bank deposits into pesos at a rate far worse than the market rate, a policy that became known as the corralón. Savers who thought they'd protected themselves by holding dollars discovered they'd actually been holding a peso claim, wearing a dollar's name, and it got repriced overnight. The Argentines who came through this intact were the ones holding actual paper dollars in a safe, in a mattress, in a safety deposit box outside a commercial bank, or in an account outside the country entirely. That physical, uncounterparty dollar didn't care what Congress voted on. It didn't care what Cavallo announced on television. A $100 bill in a drawer in Palermo was worth exactly the same $100 the morning after the Corralito as it had been worth the morning before. Paul Bluestein, the financial journalist who chronicled the crisis in his book on the imp's handling of Argentina, documented how the wealthiest and most crisis-literate Argentines had already been moving cash out of the banking system for months before December, some literally in suitcases to Montevideo, across the river in Uruguay, where Argentine flight capital became such a common sight that Uruguayan banks built entire private banking divisions around it. The distinction that mattered wasn't dollars versus pesos, it was banked versus unbanked. Rome taught the same lesson 17 centuries earlier. With gold you could weigh, versus gold you could only trust on faith. Argentina just ran the experiment, with a modern banking system standing in for the coin. This is the reveal that sounds like a mistake until you see the mechanism. During the collapse, owing money in pesos was one of the best financial positions in the country. Here's exactly why. When Argentina abandoned convertibility and the peso lost roughly 70% of its value, The government passed a pacification law converting dollar-denominated debts mortgages, business loans into pesos, largely at the old one-to-one rate. A homeowner who owed $100,000 on a mortgage suddenly owed 100,000 pesos instead, and a peso, within months, was worth a fraction of a dollar. That homeowner's real debt burden, measured in the dollars they'd originally borrowed, had just been cut by roughly two-thirds overnight. By government decree, banks, many of which held dollar liabilities to depositors while their loan books were forcibly pesified, absorbed the difference and screamed about it for years afterward in arbitration courts. But for the ordinary borrower who kept their job, kept their income even in devalued pesos, and kept making payments, the pacification law was the single largest wealth transfer of the entire crisis, and it flowed directly into their pocket. This mirrors what happened in Weimar Germany 8 decades earlier, when German industrialists who'd borrowed heavily paid off their loans in marks worth a fraction of what they'd borrowed. It mirrors Rome's debased denarius transferring wealth from creditor to debtor across the 3rd century. The mechanism is always the same. When a currency devalues and debts don't reprice at the same speed, the debtor wins and the lender absorbs the loss. Argentina's version just had a name and a legal signature attached to it, pacification, instead of centuries of quiet erosion. Real estate in Argentina has, for generations, operated on a parallel logic to the rest of the economy. High-value property apartments in Buenos Aires, farmland, commercial buildings has typically been priced and often transacted in US dollars, regardless of what the peso is doing. This created a strange, specific advantage during the crash. An Argentine who owned an apartment outright, with no mortgage, held an asset whose price was still effectively quoted in dollars, even while salaries, pensions, and bank balances were being repriced in collapsing pesos. Property values did fall in dollar terms during the acute chaos of 2002. As forced sellers, people who needed pesos immediately to live, dumped real estate at panic prices to buyers holding the increasingly rare thing everyone wanted, cash dollars. But those panic prices were the buying opportunity, not the lesson for the seller. Within a few years, as the economy stabilized under a floating, competitive peso that made Argentine exports cheap and the economy grew again, dollar-denominated property in Buenos Aires recovered and, in prime neighborhoods, went on to multiply many times over through the 2000s. The asset that mattered wasn't real estate in the abstract. It was real estate held without debt, priced in a currency that wasn't collapsing, by an owner who wasn't a forced seller. The same property, owned by someone with a dollar mortgage who lost their income and had to sell in the panic of 2002, destroyed that owner financially. Structure, not the asset category, decided the outcome, exactly the way a self-sufficient Roman villa survived the 3rd century, while a trade-dependent estate didn't. By 2002, with roughly a fifth of the workforce unemployed and pesos losing purchasing power weekly, millions of Argentines built something the formal economy no longer provided. A parallel barter economy known as the trueque, organized around barter clubs that issued their own local credit notes, completely outside the peso and the frozen banking system. At its peak, several million Argentines participated. Inside that economy, credentials meant almost nothing. What mattered was a skill someone else needed immediately: a mechanic who could keep an aging car running when nobody could afford a new one, an electrician, a seamstress, someone who could preserve food, a person who could teach a practical skill to others. These people extracted real value from the trueque networks that no white-collar credential could match. Because the credential's worth depended on institutions, courts, employers, licensing boards that were themselves straining or frozen. While a repaired water heater or a sewn school uniform had value, nobody needed an institution to certify. This is the same finding that shows up in Cuba's special period and in Weimar Germany's parallel barter economy of coal and bread payments. When the formal monetary system seizes, portable, directly tradable skills become a second currency that doesn't require anyone's permission to use. Argentina in 2002 simply ran that experiment at national scale, with millions of participants, in real time. So here's what Argentina's Corralito actually revealed. Dollars survived, but only dollars. Nobody else had a legal claim on the moment a dollar sat inside a bank. It was a promise, and promises got renegotiated by decree. Debt survived as an asset, because a peso debt was a bet against the currency, and the currency lost. Real estate survived, but only unlevered property held by someone who wasn't forced to sell into the panic. And a tradable skill survived because it never needed the peso, or a bank, or a court to have value in the first place. The common thread running under all four is the same one this channel keeps finding in every collapse it studies. The assets and positions that survive aren't the ones a system promises to protect. They're the ones that don't need that system's promise to function at all. Argentina rebuilt. Within a decade, it had one of the fastest growing economies in the hemisphere. But the Corralito never fully left the national memory. Argentines have gone through currency crises again since. And the instinct to hold cash outside a bank, to buy property instead of holding pesos, runs through the culture for a reason. They learnt it in December 2001, at a cost most of them never fully recovered from. If this changed how you think about what a bank account actually promises you, subscribe. Every collapse leaves fingerprints, and we're here to read them before the next one arrives.